Thank you, Jessica, and thank you for the invitation, being part of this event once again. How's everybody feeling? Everybody get some food, feeling alive and fresh? Everybody that flew in yesterday, like no jet lag whatsoever, ready to go? Yeah, well, one of those gentlemen is right here to my left, Mr. John Feneck. John, go ahead and just give us a few lines. Introduce yourself, please.
Sure. Thanks, Trevor. So I started in finance in 1992 with Merrill Lynch and spent most of my career with Merrill and JP Morgan. Ended up working for Sprott briefly, and then in 2019 started my own consulting business called Feneck Consulting to address the need, I think, that exists for companies like junior mining companies that are looking for more access to the capital markets. Being a U.S. investor and a U.S. PM, I tend to attract a lot of U.S. investors, and I'm happy to say, like, September was a blow-up month for us. We had 189 new clients come at us at once, and we don't even have that many clients in total. So I think the bull market is officially here, and hopefully many of you feel that same way in the room.
And Florian.
Yeah, grüezi wohl, everyone. I'm very happy to be here again. I'm 30 years in financial markets already. I started, of course, buying a physical ounce of gold, and then there was no turning back. Once I held that shiny, beautiful metal in my own hand, I started investing in the first bull market in 2001 to 2011, heavily in the mining stocks. I've been always, first of all, investing my own money, and then started my business, Midas Touch Consulting. I publish research on a daily, weekly, monthly basis. We have a large clientship all over the world. I publish my research in German and in English, and we've been very early in the digital asset space as well. So I've been one of the very few gold bugs who has always been saying you want to hold both, that Bitcoin and gold complement each other, actually. And yeah, I've been speaking here in Zurich for many years already, thanks to Jessica. And this time it's a little bit different format, but I'm very much looking forward to the discussion with you.
All right, gentlemen, we have not too much time, and we're going to tackle a lot of different things, particularly with the precious metals market. So if you bear with us, we're going to talk kind of high-level, fundamental, macro discussion of some of the headlines that really has been in my on my desk for the last like 3 or 4 days, to be honest with you. And then we're going to go into some technicals. Florian has some charts on potential gold price, and then John has some company-specific ideas for everybody. So a little bit of everything in this discussion. So I woke up this morning here in Zurich, and looks like there was a little bit of move in the gold price, up almost 2%. You could look at this chart on the daily and say it looks like it's ready to break out. A lot of this is going to be fed by the speculation that the U.S. government potentially has an avenue for reopening. We will see how things progress. But I don't necessarily think that is the entire case moving this thing in gold. The headlines out of the Truth Social accounts lately include a $2,000 stipend from tariff revenue that was announced by President Trump. Sounds a lot like COVID. We have a 50-year mortgage idea in the U.S. housing market. And we also have decreased tensions with trade war between the U.S. and China. So all these things are moving on the headlines. Watching this and these ideas and spur of the moment policy ideas that are just typed out on social media. John, how you and I are the only Americans up here on the stage, and maybe we tackle this out, and then Florian can tell us how to calm down. But watching these headlines, how are we to make sense of this, and how is this not just more bullish for gold?
So, I mean, Trump is the master of misdirection, and he is with this U.S.-China high five, kumbaya, whatever you want to call it. It really is not sustainable, and that's how we literally said this as soon as we started to see equities selling off about 2-3 weeks ago. In the mining space, is that this is a buying opportunity, and we've been pounding that home every single third day, I'd say, through my subscription service. We have a real-time email service, so I think it's very helpful in a hot market like this. 50-year mortgage. That sounds nuts.
What could go wrong?
What can go wrong with that? We're as a country, the U.S. is in serious trouble right now. We have a huge debt problem. I mean, on the consumer level, the consumer to me is what led the markets higher from March of '09 to where we are today. And when you look at Amazon and UPS laying off tens of thousands of people just last week, that should be a warning sign, that the U.S. economy isn't doing as well as we think. If you don't believe me, take a look at the U.S. non-farm payrolls number August 1st. My partner, John Durrett, and I, have a show that we talk on, a podcast called the Feneck Commodities Report. And we said, as soon as we saw that number with the 258,000 jobs revised, we were like, this is the last shoe to fall. Like everything else looked pretty bad from an inflationary standpoint, from GDP, 2 negative reads in a row this year. There's a lot of warning signs out there, yet markets keep melting higher. So clients are confused. And we've been saying there's been 2 camps being built, the tech momentum bro kind of camp, which is clearly working in AI stocks all year, last year, right? And the people that are more disciplined and have more of a long-term, oriented approach that appreciate value. And there's a ton of value in this market. So we see a lot of opportunity, but we think a lot of this right now is optics.
Yeah. Florian, I mean, being an outsider looking into the American economy, how does that kind of frame your investment thesis?
Well, I'm honestly of the opinion that while in the 1960s up into the 1980s, the East was bluffing, and America was a strong country. Nowadays, it's actually vice versa. I think the West is just bluffing. I think the war is lost in the Ukraine. I think AI is eating all the jobs, and I think the confidence in the US dollar system is melting by the day. So I'm very much focusing on sound money, on hard assets. Of course, that's why I'm here in the precious metal sector. That's why I'm interested in mining stocks. That's also why I'm primarily buying physical gold and silver whenever I can. And that's also why I'm interested in the digital asset space when it comes to Bitcoin and a few other selected coins. Although you have to be a little bit more selective there, or I would need more time to differentiate on that. But I think that's the big picture that I see. I think China is just waiting for the dead bodies to pass by because the West is doing any and every mistake. And yet again, for us individuals or as a fund manager, a money manager, I mean, there's huge opportunities. I think the mining stocks, the mining sector, the whole commodity sector is still very much undervalued. We are in a secular bull market. I think the best is yet to come. We know that this precious metal bull market in the last inning, basically, you see crazy spikes to the upside. I think this is all still to come. So I'm very happy in the sector that I'm active, and I feel the macro picture wonderfully fits together with it.
Yeah. Maybe looking ahead as we begin to wrap up 2025, looking ahead to 2026, you're absolutely right. The economic data out of the U.S. is cracks everywhere. We've been in a manufacturing glut for better part of 3 years, I would argue. Maybe it's a benefit for the U.S. government to be shut down, so we actually don't see the data. Maybe they don't want to show us. But once that comes out, so I'm looking forward. I put out a message on Twitter X the other day where we're starting to also see the AI trade get really scrutinized to see return on the capital spend and data centers. And if you look at CapEx spend, AI is just eating everything up in the United States. If you take that away and that gets hit, I mean, there's a real problem on the horizon. Now, the reaction of it, I mean, there's never going to be austerity with the debt. They will continue to print and debase. And it just kind of feels like we are within 12 months of potentially QE to affinity coming back into our lives. Is that the next move by central banks to begin printing money?
I think so. I mean, we have already seen it. Just a week ago, the Fed pumped 125 billion over 5 days into the markets. And this is going to continue. And I've been for a long time saying that I believe we are in some form of a cracker boom. meaning the real economic activity not necessarily is what you basically betting on if you are active in the markets. It's just the liquidity and the money flow. And they will expand it, they will print more, and this is happening all the time, not only in the US, but basically everywhere. The Eurozone probably is next too, and I mean the Chinese as well, everyone, everywhere. And so you need to be in hard assets. It's actually very simple.
Do you have any thoughts on that? QE infinity once again?
Well, if you look at what the Fed just said in September, I mean, he was, or at the most recent meeting, I'm sorry, in October, he was quite hawkish in that meeting, but we immediately put something out about 4 minutes after that saying this is just not sustainable. Like, we were going into that day with the December 10th meeting, or whatever day that is, with a 91% probability of a 25 bip cut. And after that day, it was 88%. As we sit here right now, it's 66%. It still doesn't mean 0%, right? Like, there's no way the Fed can do 0 cuts or moderate their cuts. Like, their back is against the wall, in our opinion. So I wanted to touch on something else you said, Trevor, because I'm of the firm belief from working for companies like JP and Merrill for most of my career that most people have the bulk of their wealth in their 401ks, in their retirement plans, and they are laden with things like S&P ripoff funds that are huge in tech. If you look at the numbers right now in the SPY, which is the S&P 500 ETF, it's about 45% in technology stocks. This is way higher than it was in 99 going into 2000. So there's a lot of alpha being driven by a handful of names. We call that the Mag 7 in technology. What you call it AI, you called it AI, whatever you want to call it. When these companies start waning, there's going to be a mass exodus. It will appear to be a mass exodus out of stocks, but it's really just tech correcting because it's such a large weighting.
Well, and a lot of that flow is coming in through passive investing, which has obviously made retail investors' life a lot easier. But Michael Green is the king of talking about the risks and dangers of just how over-leveraged and overused passive investing is. And if that actually starts to crack, the windfall event is something like Ronnie Storfley said this morning, happens gradually, then all of a sudden. And it's just a really dangerous place to be in. And especially now you have 3-4 times leverage ETFs. It's like
yes.
Does the market really need 4 times leverage on NVIDIA?
Well, I come from the mutual fund and ETF world. That's what I did for most of my career. And most people don't understand that the U.S. financial advisor right now has been forced to do a couple of things over the last few years. One is what we call create glide path products, which are, this much in the S&P, this much in the Russell, this much in the NASDAQ, this much in the EFI, and then set it and forget it, right? You risk profile a client, they fit a particular bucket, and then you put them in that model, and guess what? It's been working. It's going to stop working next year. This is the thing that people don't understand, is that March of 2009 to now is a huge run-up in the market. It's never happened like this. So we're at kind of firsts in a lot of ways. The gold price, new high, silver a new high, AI stocks new high, real estate 2 years ago new highs, right? Like we're at the precipice right now, I think, and I think that really bodes well for companies attending this particular event because there's so much value at this conference. It's unbelievable, because when you add up all of the mining companies globally, all of them, it doesn't even add up to the trading volume in NVIDIA in one day, on a moderate day. It's unbelievable. So.
Let's start diving specifically into the gold sector and then talk about the mining equities. Florian, you put together some slides for everybody, which you always do really, really well, and kind of pace what you're seeing in the gold market, and today being just a pretty exceptional day.
Yes, I mean, we don't have a lot of time, so I just give a quick update today. I have a gold chart, a silver chart, and a bit of a seasonality. So, yeah, that's by the way a very
just show
funny
it,
one.
Florian. Don't be bashful. Come on.
Okay, so the daily chart. We had a nice pullback after a massive, unprecedented rally in the gold market. 8 weeks, and it went up from 3,311 end of August. It went up to a double top around 4,380. That was a 32% gain in just 8 weeks. I haven't seen anything like that in the 25 years that I'm in the gold market. Some of you guys who were around in the 70s might have seen it. So that basically is the new all-time high, 4,380, and it has had a quick, sharp pullback, nearly $500 in just a week, minus 11.3%, and we made this low at 3,886. This is just 2 weeks ago, and gold is already climbing again. It took 2 weeks, maybe kind of a bottom-building pattern here. And today it bounced back up to 4,075-ish. That's where the first typical retracement level would come in. And yeah, it doesn't look too bad, actually. Usually, if you go back the last 1.5 years, any of those sharp pullbacks, the initial first sell-off was already marking the low. So most likely what we're going to see now over the next few weeks is some sideways ranging, consolidation, probably maybe even above 4,000 it can hold already, and then on the upside around 4,300, 350-ish. So that's the critical here, this orange circle. That's where we basically traded this morning here. You see these orange kind of lines. That's the typical Fibonacci retracement levels. Very basic stuff, but it gives us an indication where gold is. So if we can take out today's highs around 4,080, we're probably going to see 4,200 rather quickly. And then you see already in the background these blue bands, is the Bollinger Bands. The market trades 95% of the time within those bands. So I think over the next 1-2 months, very likely we're going to test 4,300, 4,350, and then probably come back down one more time. You see there's this blue line coming in from below. That's the 50-day moving average. Beautiful support so far. It has held all over the last 1.5 years, and most likely will hold this consolidation that we are in right now as well. So it looks all pretty positive, and you can see my favorite stochastic oscillator down here has given a new buy signal. So I'm very bullish in the very short term. I'm a little bit not cautious, but like maybe patient in the midterm, and of course in the very long run, I'm still very much a gold bull, and I believe we're going to see $5,000 next year, and then at some point it's going to go to 10 and probably even higher. It looks very good. I didn't brought, so that's maybe the forecast for the next few weeks. I didn't brought a long-term gold chart because I think the big picture is much more important now in silver. And I think that silver is now going to lead the show in the precious metal sector. So this is 55 years, the mother of all cup and handle patterns. Silver was running towards $50 in 1980, then again in 2011. And now we finally have this breakout. And I've been pounding the table for the last 1.5 years that silver is going to move to 50. I also said we probably will see a pullback around that area. It did. It first did an overshoot to 54.45 and now came back below 50. But this breakout is in the making. And if you look at the gold market, we had a similar pattern, not a 55-year cup and handle pattern, but a 13-year cup and handle pattern. The energy that gets compressed in these cup and handle patterns is huge. And the unleash is also huge. And that's what we've seen in the gold market. Gold more than doubled over the last 15, 16 months. And I expect silver to do this similar thing easily and probably much more because the energy that has been compressed here in 55 years is unbelievably. So, and that is the most important thing for you to understand, I think, where we are in this precious metals bull market. This cup and handle pattern, once it breaks, and basically it has already broken, it's just a pullback that we're seeing right now. The depth of the handle will take us to more or less $100, roughly speaking, and the depth of the cup will take us on a logarithmic chart to $300 until $500 in silver. And if you look on a gold-silver ratio chart, it is possible if gold goes to, let's say, $10,000 down the road over the next 2, 3, 4 years, And in the last top in 1980, at that bull market top, the gold-silver ratio traded at 15. So these numbers seem to be very crazy right now, but it is potentially possible, especially since we know that silver is always showing up at the end of a big party and then going completely crazy for a while. So I think that's the most important thing for you to understand. This cup and handle pattern is broken and silver is on the run, and it will probably lead gold higher as well over the next 2 years. So in the short term, we had this start in final August. 36.87 was the start of the silver rally. The recent one, 47% in 8 weeks, massive move higher, a head and shoulders topping pattern, and now looks like we're gonna see a head and shoulder bottom, inverse head and shoulder bottom pattern. Silver was already looking strong last week, Thursday, Friday, and it broke above this neckline. It's already moving, pushing higher, basically leading the market. So I zoomed in. It's a very short-term chart, but I wanted to show you this. I think we have already the bottom in the precious metal scene. We might see another 1-2 months of consolidation, but actually it's time to be bullish again. You can see here also the Fibonacci retracements level. Silver is a step ahead already. So yeah, I think overall, very bullish setup, very positive for the next year. If you take the depth of this bottom pattern here, silver should go to probably 53 rather quickly. And final chart, the seasonality, which I always like to show you. Usually there is a top in the precious metal sector somewhere around September, October, and then you get this pullback into December. And for many or whatever reasons, it's most of the time that the turning point comes in with the last FOMC meeting of the year. This year it's around the 10th of December. So that probably is the time when gold starts the next leg up again. And until then, we might see some back and forth. And remember, into the next spring, January, February, March, even April, best time of the year for the precious metals. Of course, driven by the new year in China in early February, physical demand, and we also know that miners usually have the best time of the year, January, February, March. So over the next 2 months, it's time to increase your position or get a position.
I can't believe that price chart on silver. That's the highest forecast I think I've seen.
Well, I mentioned it's a logarithmic chart, so if you take the depth of that cup and put it on this potential breakout around 50, it takes you to $250 to $500.
All right. Well, if that's the case, I'm coming to find you. We're having a steak dinner, okay? Okay, so let's bring it back towards the mining equities here, and I actually want to talk about valuations here using the current metals prices and how we're supposed to kind of go about this. Is Ronnie in the room? Ronnie's not in the room. Ronnie actually said something in this morning's presentation that I wholeheartedly disagreed with him with, which is rare. And he said that mining companies in their technical reports are using, $2,500, $2,800 gold, and therefore they don't believe. He said they don't believe in this run up in the gold price will last. Well, I couldn't disagree with him more. I think they're beholden to use that conservative number. Just based on average price movement over the last 18 months. And again, a year ago we were at $2,800 gold. This is how big of a run-up we are, and so you have to be very constructive and conservative when you're putting out those cash flow models here. But now we're at $4,000 gold, and if we think the bottom is in, relative bottom, how do we go about doing our valuations and our investment thesis now? Like, I'm not saying the companies need to use these numbers, but as a retail person or an institutional who's doing these cash flow models, what is appropriate base case in gold and silver right now?
So to piggyback on what you just said, the reason a lot of junior companies use a smaller number in their calculations when they're restating a PEA or coming out with a PEA or something like that, instead of using 4,000 gold, is because they have to use a 3-year look back. And so 2,500 to 2,800, 3,000 maybe sometimes you'll see. But, the conservative nature of that is an opportunity for investors. Another thing that's an opportunity for investors is I started my career in '92 as an analyst for Merrill Lynch. Most of the analysts in this sector are terrible. They don't understand how to take risk and go out there on a limb and say, well, we're trying to, like U.S. Gold, right? USAU gets their permit in November. I saw one of the analysts raise their $1.50 target. Wow, don't get crazy. They just got their permit in Wyoming. Like, they're going to build this mine. Like, they have the capability to build this mine. And then you saw other analysts jump on board after that, months later. But it's like, how does this take weeks or months? Like, this sector is so inefficient, and that's the opportunity, is that there's a lot of inefficiency in this sector. Things don't move right away. Like, American Tungsten just got a $25.5 million check. That's like giving them over 60 million cash in the bank. That's the most cash any tungsten company has in the U.S. right now. And the stock went up from $1.30 to $1.39, back to $1.30 close in the same day. I'm like, 25.5 million is like life-changing. I talked to the CEO because that's what we do at Feneck Consulting. We get on the phone, ask them about public news, and say, how meaningful is this to your thesis or to what you're talking about in your presentation deck, right? So, yeah, sorry, I think the opportunity in the junior sector right now is huge, given what Florian was just talking about, is that we haven't gotten back to 3,000 gold and 30 silver, which I read a lot from these guys on Seeking Alpha that are charging $10 a month for their services, right? It's like they're super negative. They don't understand charting like Florian does. And that was your opportunity, guys. Like, that was it. We're not going to get back to $30 silver. We're not getting back to $3,000 gold. You have to buy dips. We're in a bull market. If you don't believe that, you should probably buy something else.
Yeah. Well, at $4,000 gold, every project looks amazing, right? Like, if you can't make money on make it look economic on paper with $4,000 gold, then you're in the wrong business. Like, you can go do a podcast or something. But and I want to go to this. We just got a few minutes back, but I want to approach that subject because we're getting to a point where a CEO of a junior mining game is promotion, and they will use these. That's one of their jobs. And they're going to put out these technical reports and see this is economic, and then the PEA is economic, the PFS is economic. They're going straight to feasibility study. And all of a sudden, you have all these junior developers who have the best economics on paper, but we have a point, like, how many of these things do we really need to build? And I think that's a philosophical question we need to ask ourselves. Who gets built? And which ones do we as an investment community say, now's not the time? Out of the 1,500, maybe we only need a few of them.
Yeah, it's true. And I mean, you always have to remember only one in probably 1,000 of these projects and companies really builds a mine in the end of the day. That's very important. And you can see it even in this conference. There's lots of new companies showing up, right? But that's the normal process in a bull market. That also is always a job of the bull market to basically provide new capital to build these projects. We've seen this, for example, also in the internet bubble. I mean, we wouldn't be able to use all these internet tools nowadays, which are totally normal for us, if we wouldn't have had that bubble in 2000 where lots of money came into the sector and basically built the backbone of that infrastructure. So it's a total normal part of the bull market. You guys have to be careful with what you're buying, and you need to understand the time frame that you're moving in. And you should not marry any of those investments, but understand that there is a certain time frame where you can make a lot of money, but then there's also a time where you probably have to say adios and goodbye. I think overall, of course, after this long bear market and this very difficult period of time, it's totally normal that people holding back and are a little bit cautious. But I think we're seeing things dramatically improving, not only from the price side. I personally wanted to mention here, for example, Mexico permit Friday, first one for Silver Tiger, huge step. I think that's transformational. I think the whole Mexico story is very much back on the radar now. It's very interesting. And yeah, you have to just believe in yourself as a CEO during difficult times, and you have to, of course, use a little bit conservative numbers at some point, but always also make sure that people understand what the valuations can be at higher gold prices, right?
Yeah, piggybacking on that, Mexico open pit mining has been a disaster under AMLO, and Sheinbaum came into office 13 months ago, and she's handed out a lot of permits, but not open pit until Friday, right? So that's huge for Silver Tiger. It's big for Sonoro Gold, which is right near there, SGO in Canada. It's big for Gold Group, who's here at the conference, GGA. It's big for Gold, which has some relations to Silver Tiger in terms of board members. Discovery Silver.
I was just going to say Discovery.
Discovery is the big boy down there. Yeah, absolutely. And you know, I just interviewed David Wolfen at Avino. He's been in Mexico for years. They're killing it. I mean, there's so much going on in that jurisdiction, but you have to be selective, like you said. I mean, it's you can't just use a shotgun approach in Mexico. You have to look at the jurisdiction.
All right, Jessica just gave me the face to wrap it up. So that's what we're going to do here. Not even time for questions, but if you got anything for any three of us, we'll meet you in the foyer. Thank you so much. Thanks,
Thank you, everybody.
Thanks.